Hello, everyone. Ted Bauman here. I'm back again. I first want to say thank you so much for all the positive feedback that I got. I was really amazed. I mean, I had no idea that people valued my input so much. I will do my best to live up to your expectations. And thank you again so much for um, telling me how much you appreciate what I have to say. Now, today I wanted to talk about what happens to, or what to do with stocks that have really pulled back strongly, from the big peaks that we saw late in the COVID boom. But before I do, I just want to make clear one thing. I am not a registered stock advisor. My what I say here are my opinions. I am not giving you direct stock advice on any individual positions. I'm just saying, you know, as a general proposition to everybody who watches these videos, this is how I would approach this kind of stuff. So just remember that anything that you do on your own account is for your own account. I do not. I recommend that you do your own due diligence, do your research before you make any stock trades. Now, let's now look at some charts that help to explain why so many stocks that were such high flyers have collapsed and where they are likely to go next. All right, let's start with a chart that shows the long-term PE ratio, price to earnings ratio for the S&P 500. Now, you know that the S&P 500 or any price to earnings ratio for anything is basically the ratio between the current trading stock price and the company's most recently reported earnings. Now, the long-term average is probably around 15, I would say. It began to tick up at the beginning of, or the middle of the 90s, and it's remained a little bit above 15. Well, it's had three big spikes, basically, what's happened. And the first one was the dot-com boom, followed by a reversion close to the mean. Then we had a collapse in earnings right at the end of 2009, along with the great financial crisis. That led to a spike in PE ratio simply because earnings fell, but prices didn't, because people knew it wasn't going to last forever. Then stocks started to rebound during the 2010s and then really spiked again post the beginning of the COVID crisis. And then they've just fallen off a cliff again. So this is the third big spike in PE ratios that we've seen. And of the three, the two that are most similar are the dot-com bust, or boom and bust, and the COVID boom and bust. And right now we're at about 20.54, which is a little bit above the long-term average. It's pushing towards the top of the long-term average, but is probably consistent with where things have been during the 21st century. And remember, part of the reason for this, I think, is because as we've moved to an information economy, companies have much lower capital outlays. That their corporate ownership is, or their corporate assets are really intellectual assets, software and things like that. And so as a result, they tend to have higher earnings relative to previous companies that had a lot of physical capital. Now, here's a chart that shows more recently what's happened with the PE ratio going back to about 2015. It rose steadily up till 2013. It rose steadily up till the middle of 2015, then it leveled off, and then it dived again. The PE ratio did right around the time that the new Fed chair, Jay Powell, started talking up the need to raise interest rates. And then, if you recall, there was a big spectacular dive at the end of 2018. Everybody thought the world was coming to an end. It didn't. They bounced back. And then, interestingly enough, if you look, people were bidding up the price of stocks pretty rapidly, even before COVID hit. I mean, so we were at a pretty significant peak in PE ratios even before COVID. And then they fell right back to where they had been at the end of 2019 during that COVID. So here's something a lot of people don't realize. The PE ratios that we hit in that terrible second quarter of 2020 were pretty much on par with where they had been for the last 5 years before that. But then look what happened. Fed cut interest rates to zero, liquidity just shot through the roof, and PE ratios shot up. But the key thing is what's happened since then, and that's what we call derating. That's what happens when people start to shed stocks, or they're not willing to hold stocks at their current prices. They may be willing to hold them, but they don't value their future earnings as much as they used to. Now, the main reason for that, of course, is that as interest rates have risen, the value of future earnings far off in the distance has fallen, but also because people realize that they simply bid up the price of stocks unsustainably, and so some of those stocks you have to get rid of them because they're just too expensive. You're not going to make your money back. Now, here's a chart that shows a bunch of stocks. I know it's busy. I've taken it back to the end of 2020, which is right around the time that I acquired some positions that I felt, kind of in a sense obligated to buy. And they included companies like Farfetch, the global luxury goods online dealer, Schrödinger, which is an AI company, artificial intelligence focusing on molecular discovery, Velodyne LiDAR, a maker of radar-driven location ranging for cars and things, Bluebird, a company that makes school buses, which I thought would benefit from the electrification drive, and StoneCo, a Latin American point of sale and business-to-business finance company. Now, the reason I put them all together is to show that when I bought these companies initially, they had just a tremendous run up. And at one point, we were up over 80% on a couple of these positions. And at that time, I will say, just in defense, that I did advise people strongly to take profits on these companies. Those who did would have made pretty substantial money on whatever part of their position they decided to liquidate. But then things started to turn right around February 2021. And although it wasn't even across the board, the general trend has been down ever since then. There have been some attempts at recoveries, particularly early in 2022. Companies like Sibanye-Stillwater and Bluebird tried to bounce back, but then they have continued to fall subsequently. Now, here's another look at this same set of data. I've taken it a little bit, well, it's pretty much where it was before, but I've taken Farfetch out because Farfetch was such an outlier that it made the chart hard to read. But essentially, if you look, the story is clear, that with some exceptions like Broadmark, and you could say maybe Bluebird, all of these companies really, their multiples expanded. People were willing to pay more for them on a per share basis as interest rates were low. Basically they were on an inflation adjusted basis. Even during 2020, interest rates were below zero. And so that was the big thing. Then the turnaround came at the beginning of February 2021, and most of them fell off a cliff. That's where I've put that crosshair. With some exceptions, Broadmark really kind of trundled along because it's a little bit different from the others. It's not a technology company per se, although it is in the cable, fiber optic cable business. It's not a software company, put it that way. And of course, Bluebird, being a physical manufacturer, is subject to different dynamics. The key thing is that all of these companies began to see derating right around the time that interest rates spiked. Now, interestingly enough, you'll see that interest rates had already started to rise at the beginning of 2021, and that was in response to Joe Biden's election and to the Democratic control of the Senate, thanks to the elections here in Georgia, if you recall. And that made that the market thought that interest rates would have to go up because of higher federal spending. But when the rates did start to tick up at the beginning of February, that's when these prices really, really fell. I mean, look at Schrödinger. Look at even Sibanye-Stillwater. But of course, it was not a foregone conclusion that rates would rise as much as they have. But nevertheless, we saw a gradual decline in the prices of most of these stocks during 2021. Now, the next turning point came at the beginning of 2022. The market peaked on the first day of trading this year. And that bright blue line, of course, being the 10-year Treasury yield, has really taken off. And that has led to even further weakness in these stocks. Again, one outlier is Sibanye-Stillwater because it is a industrial mining company that sells stuff into the industrial sector, mainly platinum group metals, and that company is subject to different dynamics. But one of the things that hit it was the war in Ukraine and the effect that it's had on global trade, and just fears of a slowdown. If the economy was going great, guns and people were buying lots of brand new cars, this company would be doing a lot better. But the basic message here is that interest rates are the key culprit, along with just a general decision to derate. In other words, that you're not willing to pay as much for future earnings. Now, let's have a look at these companies from a different perspective. These are the tickers that I've put up there. On an earnings per share basis, all of them are money losers except for Broadmark and Sibanye-Stillwater. And that means that the only two that have positive price to earnings ratios are those two. Both of those price to earnings ratios are pretty good compared to the market. The current ratio is about 20.5. These are both less than half of that. That means that they have room to run, with one proviso. Price to earnings ratios for miners like Sibanye-Stillwater rarely get up to the levels of the overall market. Normally they're in the kind of 14 to 15 range. And so even from a miner's perspective, that company's still undervalued. Broadmark also undervalued considering what it is. A company, a REIT that owns lots of fiber optic uh, uh, networks and things in the central and eastern half of the United States. And it's that's a pretty acceptable price to earnings ratio. But remember, for REITs, price to earnings can be deceptive because, for the most part, financial software calculates earnings according to the way it would treat normal companies, not REITs. So that's a little deceptive. But my single favorite measure is always PEG, and that shows you how rapidly earnings are growing relative to price. Now, when you see a very, very low PEG like Farfetch or Ride or Schrödinger or Velodyne LiDAR, it can be due to one of two things. One is that the company's earnings are growing much more rapidly than its share price is, for example, in the case of Farfetch. The other could be that the company is simply not growing earnings at all, and neither is it growing its share price like Ride, and so you have to throw that out. But Schrödinger and Velodyne LiDAR are both companies whose raw earnings, even though they're still negative on a earnings per share basis, that their raw earnings are growing much faster than their share prices, and that's a good sign. Now, on a price to sales basis, all of these companies are technically in good nick. Price to sales, you don't want to see it higher than 10. A good way of understanding price to sales is that that's how many years of earnings it would take to compensate for every dollar that you spend on a company's shares. And that assumes no taxes, no expenditure. It's a rough and ready way of deciding whether a company is expensive relative to its sales. Now, in some cases, like Bluebird and Sibanye-Stillwater, and I would argue StoneCo, these companies are radically underpriced relative to their current sales, which means they have the potential to rise again. But StoneCo, if you look back, has a very, very high price to earnings growth ratio, which means that its earnings are not growing fast enough. So you have to look at all this stuff together. But the key thing is that if you look at a company like Ride, which has no sales, then obviously it's going to be zero. And so that measure doesn't really tell you anything. But for the others, with some exceptions, like I said, maybe Velodyne LiDAR because of its internal company problems, these companies are in reasonable positions relative to their sales. Price to book is another story. Right now, Bloomberg's price to book is excessive, but that's the only company that really has an actual physical manufacturing base, because it is a manufacturer of physical objects, i.e., school buses. And that would explain its high price to book, but still, that's still, I would say, a stock that is probably overpriced relative to its current book value. Now, Broadmark, very, very low price to book. And remember, this is a company that has physical assets. It has fiber optic networks. Those are things that have value that can be sold, and that value can be realized. So that's a pretty good price to book. Farfetch is a little higher, but not unreasonable. Ride, of course, one of the reasons their price to book is so low is because they sold almost everything that they owned except for their intellectual property to Foxconn, who took over their factory in Lordstown, Ohio, to make the product that Ride was established to make. So that's an outlier. Sibanye-Stillwater, on the other hand, extremely low price to book value. Schrödinger, higher, but again, not excessively so. StoneCo, very, very low. Velodyne LiDAR, very low. And then lastly, just to remind you that some of these do pull in dividends. Sibanye-Stillwater, over 5%. That's good. That's a forward yield. Broadmark, over 20%. Again, that's a very high forward yield. It may not be able to sustain it, but just remember, your total return is going to incorporate that if it is paid out. So the key message here is that all of these companies have got a mixed bag of valuations, and I would argue that they are pretty much near their bottom. Some of them could fall further. Certainly, Ride I wouldn't touch with a 10-foot pole. Velodyne I wouldn't buy now because there's still ongoing internal company conflicts and that sort of stuff. But the other ones all have the potential to rebound. All right, now let's look at the specific tickers that I just mentioned. And again, remember, this is not personal advice. I'm not speaking as the author of the Bauman Letter. I'm just responding to those of you who asked for some input on these positions that were in that portfolio at that time. But this is definitely not official advice, since the portfolio doesn't actually exist anymore. Broadmark, I would sell it. The company has not been managed well. Things have not gone well for it. So I would liquidate your existing holdings. I wouldn't, I wouldn't add to it, obviously. And that means that there's no price point at which I would return to it. Now, of course, with all of these companies, things change in the future. It might be worth actually revisiting this company someday, but today is not that day. Now, the next one, Ride. Ride, I wouldn't touch at all. Ride, we all know that this was an SPA company that didn't work out. Honestly, I really thought that their in-wheel electric motors were a really interesting idea. But, it's just one of those kind of things. And it's a big mistake that I made. And for those of you who've lost money on it, I apologize. All I can say is I'm not the only one who's lost big money from the people who used to work for my employer. Some very famous people with very famous names have also had terrible track records. So I would sell that one. I wouldn't buy the dip, forget about it. Now, Bluebird is a long-term buy and hold company. I think you should hang on to this one because these guys are a very big manufacturer of school buses. And there is a lot of federal money in the pipeline to electrify school buses. And these guys are the largest single manufacturer of electric school buses. And one of their big advantages is that because they've been around a long time, they have the connections at local school board and state school, commissioner level to be able to negotiate deals that some of their more up and coming competitors don't have. So I still think this is a good one. They've had some pretty good momentum this year. They've actually, they're starting to recover. So I'd hold what you have. You definitely want to buy the dip on this one because, you want to lower your cost basis. Unless you just want to sell everything and start over again. But I don't see why, because eventually you could actually get back some of your money. A breakout price here, and all these breakout prices, when I say breakout price, I mean that if it sustains a breakout over this price, like $12.75 in the case of Bluebird, $12.75 share, if it sustains that, then I think you can comfortably go ahead and add to that position, because that means that it's broken out above a prior resistance level. StoneCo, the Brazilian point of sale payments company and finance company, it's a momentum stock. It's more speculative, but it's in one of the biggest markets in the world. It's one of the biggest players. It's growing rapidly. I think it's worth holding on to this company. I would buy the dip and look for a sustained breakout over $17.40 a share before committing to add more. Farfetch, also a company of the future. It's a big online luxury goods seller or retailer. It's basically the Amazon of very fancy high-end goods. It's a momentum company. It's rapidly consolidating its presence by acquiring other companies. Soon it's going to be pretty much the main player in this space, if not already. So I'd hang on to it. I would buy it a dip if it pulls back from where it is. And look for a sustained breakout over $12.05 a share, to know that it's time to go ahead and add, because there might be a sustained run after that. Sibanye-Stillwater, this is a company to buy for its dividend, but also potential total return. I would hold what you've got, even though I know we're down, or you're down on it, if you hold it. But I would buy the dip and look for a sustained breakout above 1092. Schrödinger, this is again a company that is at the forefront of using artificial intelligence to identify potential molecules for various applications in pharmaceuticals and materials and that sort of thing. It's a big deal, and it is highly, highly rated by a lot of stock analysts. And one of the interesting things about it is that if you look at their confirmed paid, the deals that they have in the pipeline that are confirmed to pay out, they are significantly undervalued against projected income. So it's a momentum stock. I would hold it. I would buy the dip and look for a sustained breakout above 35.75. STEM I've thrown in here because I realized after I recorded the previous part of the video that it's also one that I had recommended that it's actually had a fairly good last 6 months. It's picked up a lot. It's a momentum stock. It's a company that manufactures software and hardware to help control large-scale renewable energy, particular solar arrays, for example, helping keep them oriented towards the sun for maximum efficiency. It's one of the big players in this space, also uses AI. I would hold it. I would buy the dip when it pulls back, and I would look for a sustained breakout over 1742. All right, so there you have it, folks. That is my take on some of the positions from the riskier part of the old Bauman Letter portfolio, what I would do with them. Now, remember, I know a lot of people feel, that I lost them a lot of money. Well, yeah, I mean, the stock picks didn't work out, but a lot of things were imponderable back then. And I just want to remind you how, people were looking for these kinds of stocks. Sometimes you got to throw the dice, and sometimes they don't win. Some of the other positions that I picked back then have done very well. Triple digit gains. They continue to go very well. You know what they are if you bought them. But basically, this is how I would look at it. I would look at these things in this way and say, well, if I trust Ted, I could give it a try, but I got to do my own research and check it out. So these are just my ideas. I'm not telling you to do this, and I'm not saying that this is going to be, this is certainly not official from anything. Anyway, this has been a video really aimed at those of you who held Bauman Letter positions. So I'm sorry it's a little bit long. I'll be back soon with some other things to talk about, including some of the alternative investments I mentioned, and also income picks. This is Ted Bauman signing off. Goodbye.